This week on the Roth Guy, Jude, I got something for us to discuss a little bit here. The 4% rule versus the 8% rule. Dave, Big Dave Ramsey and his empire, he says that you can do 8%, right? Because in his logic, and technically I suppose this is right, that typically the market returns 10% on average year over year. So therefore you could roll with 8%. But I want to talk about pros and cons of that a little bit because the market has been great, but just what if it's not first and foremost, right? So anyway, let's kind of do a little 4% versus 8% this week on the Roth Guy. How are you, my friend?
I am doing fantastic, and I love this topic. I can't wait.
Well, so what exactly is Dave recommending, and what's his reasoning? Can you break that down a little bit for folks?
Yeah, so Dave in his infinite wisdom is talking about what he calls the 8% rule. And basically, there's two phases of your life financially. There's the accumulation phase when you're saving money. I like to kind of give an analogy of you're moving up the mountain to financial freedom. So every time you can save $1 and add it to your 401k, 403b, you're the accumulation phase and you're moving up the mountain. And every dollar you save gets you closer and closer to financial freedom, which is at the top of the mountain. You were trading in your time for money, but then at the top of the financial mountain, you're going to start using all the money you've accumulated to buy back your time. And in that, normally there's a percentage of distribution that you're taking off of your net worth or the amount of money that you've accumulated. And so what Dave is saying is because the stock market has done so well over the years, averaging about 10%, that you could distribute 8% from your portfolio and get all the income you need, and you never have to worry about a thing, and pixie dust will reign forever.
Sure. So, I mean, easy math, we'll say $1 million, $80,000 a year is what you're talking about versus 40,000, right? If you were going with the 4% rule. Now, the catch to this, Jude, is it only works if a large portion of your portfolio, or maybe even all of it, is invested in the market. So what's your reaction to that as a protection first kind of a financial, strategist?
Yeah. When I'm talking to clients in the real world, they're mainly concerned about having income for life that they don't have to worry about.
Right.
They never want to have to worry about where the next dollar is coming from. And so using the 8% rule, in my opinion, really puts people at risk because the market doesn't always go straight up. What he's figuring the math on is a solid 10% return every year. Now, the market may average 10% over the lifetime, be up 10% this year, be down 5% the next year, and then return a higher percent the next year. And if you average it all up, it's 10%. But here's the problem with that. As you know, the market doesn't always go up. So if I, as a client, using your numbers, need $80,000 a year, and I've got $1 million, and 8% times $1 million, the math works out to that 80,000.
Mm-hmm.
But what if the market goes down that year?
Right.
If your return goes down 10%, and I asked you, Mark, hey, if you've got $1 million and the market goes down 10%, what would you need to return next year to get back up to that million? Now, you're a little bit more advanced. You're probably going to give the right answer. But what do you think typically people would say?
I think most people would say, well, if I'm down 10, I probably got to make, 20, 25 to get back, right? I think most people think they've got to make a little more to get back, but they're usually off in that assumption.
Yeah. And you're right. Some people do believe you have to make more. What I commonly hear is people say, if I'm down 10, I need to make 10 next year, and I'm back up. No. Because if you're down 10, now your portfolio is 900,000, and 10% on 900,000 doesn't get you back up to $1 million. You actually need about 12% the next year to get back up to $1 million.
Yeah, it's like if you lose 50, you gotta get 100, right? I mean, you could use that as the math. If you need to get back, you got to get 100, right? So kind of do that and then work your way from there.
But doing the math, here's what actually happens. If you add another 8% to that distribution
from the withdrawal,
plus being down, you actually need 22% the next year just to get back up to that $1 million.
Right.
And if you don't get it, you're further declining that $1 million. That $1 million went down to 900,000. then you took out 80,000, and now your portfolio has to work even harder to get back up to par value. And if you don't recover, that means next year when you're taking out that 80,000, you're taking out 80,000 on a lower number. And you can see how the decline can continue to happen. And before long, you may be out of money.
Well,
so there's a better way of doing this.
Yeah, that's sequence of return risk, right? So, we talk often, people have probably heard that phrase, if you're retiring in great markets for the first 5 years, that makes a massive impact versus somebody with the same numbers who retires in down markets. It's sequence of risk return or sequence of return risk. So it's something very real. And even the guy, Jude, who created the 4% rule back in the 90s, not that long ago, remodded it to about 4.7. So he's not even shooting at the 8%. He's saying, inflation and so on and so forth, we can tick that up a little bit to about 4.7. But at the end of the day, 8% still seems wildly optimistic, I think. Or maybe, again, I think this is where people get confused. And you kind of break it down from here if you want. It's easy to look at the market and go, hey, it made 21% last year. I only got 12. So my advisor must be doing something wrong. I should fire them, right? And it's like, well, did they have you 100% in the market? Well, no. I don't want to take that much risk. Well, that's why you didn't get the 20%, right?
100%. And here's how we address that problem at the firm, because we're not talking theory. That's great that Dave talks this theory.
Sure. Yeah.
But real people in real life want to make real dollars.
And I love how you said a minute ago, in the real world, what we have to do, because Dave doesn't have to make sure that this works. And if he's wrong, it doesn't ruin somebody's life. Because
Absolutely.
he's not actually building them a plan around it.
Absolutely. And I'm glad you interjected the word plan, because when we're building plans, it's holistic. We're using our proprietary GPS guidance planning solutions to look at all 5 pillars. And one of those pillars is income. And when we're looking at the income pillar, the tool that we use to provide sustainable income is our 3 bucket model of safety in the first bucket, income in the second bucket, how we strategically plan to get that income that you need, and then growth in that third bucket, so that we're continuing to grow the assets so we can provide cost of living. Because that's another thing that he doesn't address in the 8% rule. There's always going to be inflation. And so we need to grow the assets to be able to provide more income over the years. And that's really a more sustainable. I've been fortunate to be in this industry for 25 years. So we've taken clients from their working years in accumulation to retirement years, and have had clients now that have been retired for almost 2 decades. And they're getting the income that they need. And that's why plans are interactive. It's not a set it and forget it. Okay, we built you the plan. We've got your safety, income, and growth buckets, and go have a nice life.
Right.
No, we've got to adjust for what happens in the market. We've got to adjust for what may happen in Congress with tax regulation. We've got to be interactive. And that's why I love meeting with clients when we're doing their review meeting in our GPS, because we're asking them a simple question. How's your income? And depending on their response, we're making adjustments to our strategy. It's not a static thing.
Yeah, that's a great way of looking at that. So I'll wrap it up with some final thoughts here for you to kind of tackle. So based on our topic today, do you have a specific withdrawal rate per clients? Do you kind of start with a target and then adjust from there, or is it completely person to person?
That's an excellent question. I'm so glad you asked that. To give clients kind of a ballpark to shoot for, we start off with just using the 4% rule, just to kind of give us a ballpark.
Okay.
But then, to your point, we get very specific when we're putting together the GPS plan, particularly on that income pillar. And the withdrawal percentage could be different because we're building a specific bucket for income. So I tell people, use that 4% rule not only as a rule of thumb, but if you ever want to figure out what your financial freedom number is, you can back into that number that you might need at retirement. Let's say, just for example, you need $40,000 a year.
Right.
So backing into that, you'll get you're using that math, you'll figure out you need at least $1 million. $1 million times 4% will give you that 40,000.
Right.
So, but it's just a rule of thumb. It's not specific financial plan.
Yeah, and to kind of go back to where I started saying the 4% versus the 8%, $1 million, let's just say in the account for easy math, if you needed the 80 grand, Dave's sexy 8%, and that sounds appealing to you, and you're doing the back of the napkin, you're like, actually, we do need the 80. Okay, fine. Did you first off take into account anything else other than just the investment accounts that you're pulling from? Because that's the other piece of this equation, right, Jude? If couple A has 2 pensions because they both were state employees or teachers or whatever, they may not need the 80, right? Or whatever. So they may not need to pull 8%. They may be able to do 4 or 6 or 3 1/4 or whatever, right? So everybody's going to be a little different based on their Social Security. You need to do that maximization there based on whether you have pensions, you don't have pensions. So it's a complete, to your point earlier, a holistic, little puzzle here that you're putting together, and not just grabbing a rule of thumb and saying, let's roll with it. Yeah, that gets you the back of the napkin, but dive into the specifics then and figure out what you need.
Yeah, I like what you said about back of the napkin. The back of the napkin kind of gets you in the ballpark.
Get you thinking.
Now you know what you're shooting for, but then a professional is going to help you really hone in and address all the things that the 8% rule doesn't address.
Yeah.
Like inflation, like taxes, like the sustainability of taking out that income. And that's what we do with GPS, with the guidance planning and solutions.
Yeah, that's a great point. Stress test that joker over a 20-year window, right? Run those analysis. You guys can run those projections and go, here's what happens to the 8% if you actually do it. I imagine there's probably a few people that would sit down, watch you do that and do the illustration and be like, oh, I don't want to take the 8% then. That would not be good, right?
Yeah.
And it is the unknown, Jude, because we don't know what the markets will do, right? That's part of the equation too. So yes, there is some, educated guesses happening to a certain degree. We have historical data on the market, but again, look how much it's climbed, in the last 18 years. Nobody expected it to go that high, right? Who knows where it goes from here?
Yeah. I'll just tell you one last quick story.
Yeah.
So I'm going to age myself here. When I first came into the industry, I remember walking. I was working in downtown Jacksonville, and I remember walking by a newsstand, and in the cover of Time magazine in the newsstand, it said, "Will the Dow ever break 10,000?" So, look at where we're at now. Yeah. And like you said, there's no telling where, how high the Dow will go. But the thing that people really need to understand is that these general rules are great to give you an understanding, but you need something customized to your situation, because your situation is different. And you want to make sure that you've got the highest probability of having the income that you need for life.
Yeah, I'll say, look, Dave, not trying to crank on Dave. He's got some really good ideas. He's got some good things out there that have helped a lot of people, especially in the debt side of things, right? Yeah. But the retirement income planning side is a different animal, and it's not really the strong suit there. And so, again, you got to get a specific plan based around what it is that you need, and not just kind of, some of the big talking heads. I mean, he's got a big empire. It makes easy sense to go, hey, he knows what he's talking about. But at the same time, he's not in the trenches doing this every day. You're not able to go to the office and say, hey, run these numbers for me. I want to see it in black and white. And that's what you can do with the GPS and the 5 pillars and that Jude. And, and again, there's financial people all across this country. If you're not seeking Jude's help, seek somebody's help who's a qualified professional that does this day in and day out and helps thousands of families to retire, on their timeline that they're looking to do. But if you need Jude's help, he's in Florida, but he helps people all over the country as well. So reach out to him online. We'll have links in the show descriptions below to get your own GPS. Just click on those links and get started at his website there. So we'll have all that stuff in the show descriptions on Apple, Spotify, and of course right here on YouTube. Hit that thumbs up and subscribe button so you catch new episodes of The Roth Guy when they come out. Jude, my friend, thanks for breaking it down, buddy.
I enjoyed it as usual. Thank you.
I appreciate you. We'll see you next time here on The Roth Guy with Jude Wilson.
Investment advisory services are offered through Centrus Financial Strategies, CFS, a registered investment advisor. CFS does not provide tax or legal advice. Consult with a qualified financial, legal, or tax professional prior to taking any action. Information received from this podcast should not be viewed as individual investment advice. Centrus Financial Strategies does not accept any liability for the use of the information discussed. Product discussions and illustrations are hypothetical in nature and will vary based on many factors, including but not limited to age, health, product, insurance carrier, and product design. You should consult the insurance carrier website and policy for detailed information. Before investing, consider investment objectives, risk, fees, and expenses. Investments in securities involve the risk of loss, including loss of principal. Past performance is no guarantee of future returns. The views and opinions reflected in the content are subject to change at any time without notice. The content speaks only as of the date indicated. Some information was obtained from external sources. The information is believed to be accurate, but there is no guarantee that it is. Please read the disclosure statement carefully before you invest or send money. For information pertaining to the registration status of CFS, please contact the firm or refer to the Investment Advisor Public Disclosure website, www.advisorinfo.sec.gov. For additional information about CFS, including fees and services, send for our disclosure statement as set forth on Form ADV from CFS using the contact information herein.